Hello, everyone, and welcome to our webinar series, A Senior's Guide to Building a Modular ADU. This is part 10 of 10, our final one in our series. This is titled Financing, How to Pay for It All and Still Make Money. This is brought to you by Mr. John Aronson, President and owner of Crest Backyard Homes, and myself, Jeremy Knock, President and owner of Golden Age Financial Solutions. This series is designed to take you from the initial idea of building the modular ADU all the way through getting the certificate of occupancy using the HECM loan to maximize your cash flow. This is the last event in the series, but we will be hosting more series to come in the future, so be on the lookout for those. These sessions are all recorded and they're all available to share and watch later, so please do. FYI, if you want to adjust the size of the webcam, there is a bar on the side. You can make them much smaller just to see more of the presentation. Now, we break this into two parts. The first part is a 20-minute information section. The last part is the Q&A portion. So if you have a question in the meantime while we're going through this, there's a little question box. Click on that, type it in, and we will address the questions in the order that we get them. So today, we are going to be exploring the different options you have for financing and the pros and cons of them.
So Jeremy, can you cover the different financing options that we'll be reviewing today?
Sure. We're going to be looking at the financing options for the modular ADU. We'll be discussing pros, cons, and then several of the little known hidden dangers in some of them. And we're going to be comparing all those to the HECM loan, and then why the HECM loan ends up just making sense for those that qualify.
So now, Jeremy, can you walk us through the different options?
Well, you have many options from when deciding how to pay for your ADU. You could pay cash, use a traditional HELOC, do a cash out refi, maybe try for a renovation loan, or go for the highest cash flowing option, which is the HECM loan.
Wow, okay. So you may have all, some, or only one of these options, and they each have their own benefits. Some carry more downside than others. So Jeremy, can you start with the first one, paying cash, and go over the pluses and minuses of using all cash as your funding source?
Sure, John. So the first thing that comes to mind is what your reserves would be after paying for it with all cash.
Why are reserves the first thing you think about?
Well, when it comes to anything construction, you always need to plan for those unexpected costs we had previously mentioned. If you spend everything you have with nothing left in reserve and you hit a snag in construction, it can stall out or completely stop that project.
Well, that would either add massive delays to the finish, which means delays in getting a renter in. It could also potentially totally derail the project, which you didn't have any other funding sources at the time, means you wouldn't get to finish the project.
And that means all that cash is spent and gone.
Wow. What else do you think about when it comes to all cash?
Then I look at other lost opportunity costs. Now, if you can leverage and you can keep the rest of your cash in the bank, you may have the ability to pick up another great deal while construction is going on with the ADU.
Anything else?
Yeah, it's just once it's gone, it's gone. I mean, typically putting together significant chunks of cash, it either comes from a long, slow grind of sacrifice and saving, or a major liquidity event such as the sale of a high value item like a business or some other piece of real estate.
Wow. Why would that matter if they're thinking about building a cash flowing property?
I like to think in terms of time value of money. How long at X dollars a month would it take you to save up that same amount of in cash again? I mean, if that number makes sense to you, great. But if that starts to turn into 15, 20, or 25 years to get that same amount back in the bank, you may want to rethink some things.
Why is that?
Because of inflation. Your return must outpace that and your expenses to actually have any real value returned to you. Cash today is way more valuable than cash in the future.
Well, that's an important point. So now can we move ahead and look at the traditional HELOC? I'm familiar with those to an extent.
Sure, John. So these can be great tools for the right borrower. They can provide some flexibility in borrowing, but they are limited now in some areas.
Well, how's that?
Well, first off, the availability for them has really dried up. In fact, many of the biggest lenders who used to offer them have recently stopped. Not to mention, these can be reduced or revoked at any time.
Yeah, I heard Wells Fargo and Chase, just to mention a couple, just recently discontinued HELOCs. That's not a good sign for a lot of folks. As a matter of fact, I just had this happen to one of my clients. I recommended that he check his availability on the line before he started his project, and he called him up, and sure enough, without even letting him know, they had just shut it off.
That's no good. But lucky you knew to remind him to check before incurring any costs. I mean, imagine if that line got shut off midway through construction.
That would have been no bueno for sure. So what else should we be aware of when considering an HELOC?
Well, they require you to make a monthly payment. That payment is due from the very next month that you borrow those funds.
Well, I've used these funds before, as I said earlier, and it's usually interest only. Then all of a sudden you're in panic mode on where you're going to be able to come up with the money to pay the balloon, or I think you're going to be talking about something that wasn't available when I had my HELOC. But go ahead.
Yeah, so that's just another area to be aware of. It's the interest only period, and that's married to a set draw period. Those are usually 5, 7, or 10 years. These are not completely open-ended loans. That means you can pay interest only and use the line for whatever that time frame is, but once that time is up, you no longer have the ability to pay interest only, and you no longer have to borrow the ability to borrow and use that line like you want.
Well, what happens after that?
Well, it's a little known and even less talked about item called a recast period. That's when the loan resets and you have to begin paying back the full amount of not only your interest, but also the principal balance of the loan.
Yeah, see, they didn't have that recast when I had my HELOC with Wells Fargo about 10, 15 years ago. So I guess that's better than not having one at all. So why is that cause for concern though?
Well, people experience something called payment shock. For example, if you owed $150,000 at 5% and you were paying interest only, your monthly payment would be $625 per month. That's fairly manageable, right? And if your rent from the ADU was, say, $1,800, you take out the $625, you're still cash flowing about $1,175 a month. Not bad.
Well, what does that look like once that recast hits and your payment fully amortizes?
Well, assuming it was a 10-year recast and the rate stayed the same, the payment would jump to nearly $1,000 a month. So that would bring your cash flow down to closer to $800 a month.
Yeah, keep in mind you're now 10 years older than when you first built the ADU, so your cost of living has increased. So any other limitations to be aware of on these?
Yep, there's a fixed starting amount. That starting amount can never increase regardless of how much value you add to your home. The only way to get more out of the line would be to refinance it, which incurs more closing costs. Add that to the previously mentioned risk of the lender reducing it to zero. Not the most secure financing tool for a long-term strategy.
No, it sure isn't. All right, Jeremy, so let's look at the next probably most commonly considered option that almost everybody's familiar with, and that would be the cash out refi.
Sure. So this one has the benefit of all that money being available at closing. Once it's in your checking account, the lender can't cancel that. It gives you the security of knowing that whatever money you have from the loan is yours. Helps to set your budget. You can also use the funds wherever you want to.
Oh, any drawbacks to this one?
Well, you'll have to make a monthly payment starting the month after the loan funds. You'll have to keep making it before construction starts, during construction, and after construction.
That cuts into your monthly cash flow for sure. So what if there are delays in construction?
You'll just have to keep making that monthly payment regardless of what happens. Remember, you won't start getting any rent until the certificate of occupancy is completed and you have a renter in the property. That could be anywhere from 6 to 18 months, depending on what type of ADU, the size, and the season. On top of that, the amount you get is fixed. If there are unexpected construction costs, that could cause serious problems.
Whew, so true. So Jeremy, let's look at the next option, and that would be the renovation loan.
So these loans can be a great tool. You can usually go over the current value and in fact potentially use a portion of the projected value.
So what's the catch?
You can only use the funds on that property. In fact, there will usually be an added chef in the kitchen, so to speak, and that's going to be a fund control manager.
Anything else to look for?
Yep, because these can offer more limited funds, because they're based on speculation, they're also going to be subjected to some higher interest rates too. You'll also have to keep making a monthly payment. Now, not right away in the first month, but most likely by the third or the fourth month, and then from then on.
Whew. Keep in mind, folks, because these are usually considered short-term loans, you'll be looking for what is called a takeout loan for the long-term refinancing after the construction has been completed.
Yep, and that means you'll pay closing costs again. Also, what if values drop in the next 6 to 18 months and you're stuck with it? That could prove expensive.
That would mean less cash flow during retirement. So now, Jeremy, let's look at the last and what we consider the best option, of course, and that would be the HECM loan.
I agree, John. This usually pencils out to be the highest cash flowing opportunity for folks because there's no monthly payment required before, during, or after construction of the ADU, or in fact, anytime during having a HECM loan, even if you just use the HECM loan to pay off your existing mortgage.
And remember, folks, these HECM loans have no set payback schedule.
That's right, John. That means you could keep that loan and live in that property until you're 150 years old and never be required to make a monthly payment.
Would you come to my 150th birthday party, Jeremy?
If you live to be 150, John, I will personally throw you the 150th birthday party.
What if I wanted to make a payment?
You still can. You can pay as much or as little as you want each month, and there's never any prepayment penalties for doing so.
Okay, so what is the other big difference between a traditional HELOC and a HECM? I mean, a lot of folks are always asking me, well, isn't a HELOC a HECM? Or they kind of get the acronyms a little mixed up.
Yeah, they can be kind of confusing. So with the traditional HELOC, the amount is set, right? And then again, it's not even guaranteed. The remaining HECM line of credit actually grows over time.
This is something I need to talk to you about because I haven't been able to quite wrap my arms around that whole concept, but we'll save that question for another time. So are there any restrictions on where I can use the funds from a HECM loan?
Nope. You can use the funds to build the ADU on your primary residence, rental property, both. I mean, you could use this thing to, like we mentioned earlier, buy an RV, take a trip. You can really use the funds anywhere you want.
I like that idea. So these are also non-recourse loan. Can you explain that a bit?
Sure. Non-recourse basically means that you can never owe more on your property than it's worth. Because a HECM loan is FHA insured, even if your loan went upside down like so many did in 2007, 8, and 9, you could walk away and the bank can never come after you, your spouse, your heirs, or your estate for the difference.
Wow, that's a pretty significant difference. So now, Jeremy, let's look at more of the benefits for the HECM loan and why this one just makes sense.
Yep. So we'll start with what most see as the biggest benefit to the HECM loan, and that is that there's no monthly payment required.
So how does the actually translate to a homeowner or an investor's pocket?
Well, because there's no payment, you get more cash flow. You can't get into a cash crunch because you don't have to service a debt while you're building an ADU. No payment also equals improved debt ratios. So for your future investments, this one isn't going to affect that at all. And no payment gives you flexibility because you can make one if you decide you want to make one.
Yeah, remember, you can make one if you want, but you don't have to. So what else, Jeremy?
Well, there's no set payback schedule. That means you can live in the home until you pass away, which most folks want to do these days, and you'll never be required to make a mortgage payment.
What else does that schedule provide in terms of benefit?
Well, there's no end to the draw period. That means you can use it, pay it back, and use it again for as long as you have the loan. There's also no potentially dangerous recast period to create payment shock or cut into your cash flow during your later years when you most need it.
So what happens to the unused portion of the HECM loan?
Well, the remaining unused portion of the HECM line of credit grows over time. So even if you don't need all or some of that money today, you'll have even more available in the future to use when you need it. And I just want to add one more thing here. You can use one of these things to build an ADU on, say, a rental property, push the value of that property up, and then potentially sell that property, pay the balance of the HECM loan down so that your remaining line of credit grows. It's a really, really unique strategy to be able to kind of use yourself as the bank rather than continuing to go to the bank back and forth and asking for money and paying closing costs over and over again.
Well, that's right. Also, the highest cost of aging in place is going to be healthcare costs. So having a big chunk of money to use to pay for that is some real peace of mind, I would think.
Oh, yeah. Healthcare costs are rising daily, and having this as a strategy to pay for it gives you, your spouse, and any adult children you have that same peace of mind.
Sure, much better than having to go into an assisted living care facility at 6 to 10 grand a month, that's for sure. And remember, folks, you can use the HECM loan funds to build your ADU on your primary residence, rental property, or both.
Yep. So that means you build the ADU on your kid's property. You can go visit them. They can rent it out when you're not there. You can also build one on your property to house an in-home caregiver to bring your costs down for that. I mean, just that room and board feature for housing that care person, I've seen bring the monthly cost down by $2,500 to $5,000 per month, depending on the level of care required. That's money back in your pocket or your portfolio, or it means you don't have to draw that much from your portfolio, giving you more opportunity in the future. And all that money ends up ultimately being left to your heirs.
And again, these are non-recourse loans, which leads back to how all the important parties in your life are all protected by these loans. Can you go over the protections that the HECM loan provides?
Absolutely. So first and foremost, I go back to there's no monthly payment required.
Okay. I know we keep saying that, but how does it come down to the dollars?
Well, if you experience a loss of a spouse, it's very likely that you'll not only lose the loved one, but also their income too. If you're each getting, say, $1,500 a month in Social Security, and you lose half of that, it can be catastrophic to your finances. If there's a pension, and that pensioner is the one that passed away, the pension usually stops too. I've seen folks lose a loved one and then lose 60 to 70% of their fixed retirement income at the worst possible time to lose it.
Yep. Not only are you dealing with the emotional side, you now have all those financial hurdles that just came up as well.
Yeah, I mean, imagine if you were making a mortgage payment when that happened. You could potentially lose your house. And that leads me to the next protection, which is the no set payback schedule. That means you could lose your spouse, and if you have a HECM loan and you lose all that income from your spouse passing away, you can still keep the HECM loan in place, which means you don't ever have to worry about making that monthly payment.
So what about if I lost my spouse after getting the HECM loan? What happens to the HECM line of credit?
Then you still have access to it. There's no end to the draw period and still no set payback schedule. That means even if you lost your spouse, you still have the HECM line, which is still growing. Then, when you need it, you can use it. You can pay it back if you feel like it and use it again if you want to, or you can use it all and never be required to make a monthly payment on it.
And because there's no recast period, you don't have to worry about that happening even if you lost your spouse.
Exactly. And because the HECM line of credit can never be reduced or revoked, it gives you peace of mind knowing you can still protect your spouse long after you pass.
Now, what if my home decreases in value? Does anything happen to that HECM line of credit?
Nope. Because these are FHA insured, the remaining unused portion of the HECM line of credit will still grow over time, regardless of the market or your home's value.
And the whole time they're still non-recourse.
Yes.
Can you give us a real world example of what that means in terms of dollars and equity?
Yep. So remember, it means you can never owe more on the home than it's worth. So let's say you have a home worth $500,000. You borrow $250,000, you use it all. 10 years later, you owe $350,000 and we have a market crash. Now you owe $350,000 on a house that's only worth $200,000. Technically, you owe $150,000 more on that house than it's worth.
Yeah, so then what happens?
Well, if you want to stay put, absolutely nothing. The homeowner can stay in the home for as long as they want and still not have to make a monthly payment.
So what happens if they want to get out of the house or need to get out for, say, health-related reason?
They could literally walk away from the house, leave the keys on the countertop, and never give it another thought. Because the loan is insured, the lender would follow the legal foreclosure process, sell the home at auction, and then whatever money they got from the auction is theirs.
What happens to the rest of the money that's owed?
That's where the FHA mortgage insurance kicks in and pays off the difference. Because the lender is going to get made whole by the insurance, there's nothing for them to come after anyone for.
Wow. I remember hearing horror stories from the 2007, 8, and 9 crash when the economy tanked, where the bank was coming after folks for hundreds of thousands of bucks, even after getting foreclosed on and losing their homes.
Yep, me too. And that's because the home is just the collateral. You're still borrowing the money and that obligation was still owed. But with these, that's not the way it works. So think about what that means in terms of financial protection for you, your spouse, your heirs, and your estate.
Well, now speaking of heirs, what happens if, say, I had a HECM loan and I passed away? Can my kids still get the house?
Yes. In fact, your kids or other heirs will have 12 months to do something with the house. They can pay it off in cash if they have it. They can refinance it with other financing, Or if they're unable to qualify or unwilling to deal with a rental, for instance, because maybe they live out of town, they could sell the property.
So what happens to the equity?
The balance at the time of either refinancing or the sale gets paid off. The remaining equity goes to the heirs. Now, if they refinance, obviously the equity is going to remain in the property. If they sell it, the HECM loan balance gets paid off and the remaining equity goes directly to the heirs.
Well, that's incredible. But what happens if 12 months isn't enough time to deal with the sale of the property, especially if you're in a down cycle in the market?
Well, then they can do a 6-month extension. That means they can have up to a year and a half to deal with this. So if it's a rising market environment, they can ride it up, sell, and get more money later. If it's a declining market and they want to keep the home, they can let the value drop.
Why would someone care about that?
Well, that's important because the payoff for the heirs is either 95% of that day's market value or the loan balance, whichever is lower. So it really does provide the ultimate protections for you, your spouse, your heirs, and your estate. So in closing, John?
Yeah, I just want to take a moment to thank Jeremy from the bottom of my heart for taking these past very intense 8 weeks out of his already extremely busy schedule to work with Crest Backyard Homes and to help us translate almost word for word our guide to building and installing a manufactured Crest Backyard home. I've always been concerned that our guide, albeit extremely informative, would not be as an easy read for the average homeowner. Now I can comfortably and strongly recommend to anyone wanting to add a manufactured or modular ADU to their property to email me personally. And I'm going to give you my address a couple times. That's John Aronson at crestbackyardhomes.com. Let me spell that for you. JOHNARENDSEN at Crest, C-R-E-S-T, backyardhomes.com. That's all lowercase, all one word. Tell me you watched us on our webinar series, and I'll be happy. And you'd like to request a guide, and I'd be more than happy to email you on it, no charge. Don't click on the green tab, by the way, at the bottom of every page on our website, because you'll have to pay a $15 fee. Just email me directly, and I'll be more than happy to send you a free copy. Lastly, Jeremy, I just want to say thanks for having me be part of this wonderful opportunity. It's been a fun run, and I'm looking forward to working with you for years to come. With the combined opportunity of your HECM reverse mortgage and the ability of Crest Backyard Homes to provide not only the most affordable, but fastest and most painless way to start realizing years of added income on the very dirt millions of seniors own beneath their feet, we will be unbeatable combination. And lastly, thank you, ladies and gentlemen, for taking the past several weeks to join us. We hope the information we've shared with you will help you on your journey to installing your Crest Backyard Homes with your HECM loan. Thank you very much.
We really are looking forward to helping you folks realize your goals with these. If you have specific questions for the ADU, reach out to Crest Backyard Homes. He gave you his personal email there. You can check out their website at www.crestbackyardhomes.com. There's a contact page if you're looking for it. We do have one little sneaky surprise here. I actually dropped the ADU guide in today, so if you look for the handout section, you can actually grab that since you're on today with us. Grab that, download it, take a look at it. Now, if you have questions specifically regarding the HECM loan, reach out to Golden Age Financial Solutions. Their website is www.goldenaf.com. Go to the site, find the contact page, and fill it out, and one of their reps will be in contact with you shortly. So because these sessions are recorded, you can watch them over and over again. Please share them with your friends and family. We've obviously put a ton of work into these, and we really appreciate you helping us get this word out because it's going to change many, many, many seniors' lives and their kids' lives for the better. And I just wanted to lastly say thank you again to everyone who's tuned into our series. We really appreciate it. Now, I would like to open it up for our last bit of Q&A. And we've got one right off the bat. This one looks like it's for me. What are the typical closing costs for a HECM loan? And what would I have to have cash to close? So that depends on the type of loan. There's a couple different types of HECM loans. There's the traditional financing fees, title, escrow, third-party vendors, appraisal, that kind of stuff. If it's the first time you're doing a HECM loan, you're going to pay a 2% mortgage insurance premium. It's going to be upfront, rolled into the loan, so you don't have to pay that out of pocket at all. You know, that number, sometimes people look at that and go, gosh, do I have to come up with that? Nope, they roll it right into the loan, so you don't have to pay it out of pocket. And then just as a side note, to answer the what would I have cash to close, a lot of times we make it so you don't have to pay anything out of pocket. We can roll everything right into the loan. It's very, very painless. Next question is, again, the time frame questions. How long does it take to close a HECM loan, and how long does it take to build an ADU, a modular? The HECM loan, we can get them done between 21 and 30 days. If you're really motivated and you get everything into us that we need, they can go very, very quickly. There's some very important steps to follow, though, in that process. There's a really, really, really important order of operations that's got to be done. If you do it out of order, you literally have to start the whole thing over, which can be very costly. So if you're going to do one of these, I strongly recommend working with an expert that's done tons of them like myself. So John, then the second half of the question will be back to you for how long it's going to take you right now to build a modular ADU.
Well, if all the stars align in a perfect world, which we all know it isn't, anything can happen, and it usually does. But the actual time it takes to build the home itself is 2 weeks. I mean, that's all the longer time it needs to go down the assembly line and out the door and into the storage yard. The problem comes, though, with the site development and the permit process. And that's anybody's guess. And that's why it's extremely important to work with a contractor who's done it several times. I'll give you a good example. I'm working right now with a client that opted to use their own civil engineering and their own permit processing. And it's a little different animal when you're dealing with a manufactured or a modular home than if you're doing site build. A lot of your civil engineers don't understand the lingo, don't understand all the little nuances and all the nomenclature that goes into that process, and they can get tangled up at the permit counter. Sure enough, this client has been kind of stonewalled by the permit department issuing the permit for a variety of reasons that they wouldn't have had to deal with had they gone with us for the whole ride. But a lot of folks get penny wise and pound foolish. They want to shave off a little bit here and shave off a little bit there. And I don't have a problem with that. If you have the ability to go through that process yourself, all the power to you. Bottom line, there have been instances, and we're working on one right now, actually, where the permit process takes anywhere from 4 to 6 weeks. The home, anywhere from 4 to 6 weeks. The financing, just heard Jeremy say, within a week. So everything could dovetail together perfectly, and you could have a home, ideally, within a couple of months.
That'd be fantastic. So it looks like we have another question here. This one is for me. If you already have a mortgage on your house, can you still get a HECM loan? And the answer to that, in short, is yes. What we would do is we would use the HECM loan to pay off the existing mortgage. Now, with a HECM loan, you do have to have a decent amount of equity in your property because they're based on value, and then they are based on the age of the youngest borrower going on the loan, which in this case, in order to get a HECM loan, you have to be at least 62. So the percentage of value is going to be 42% of that day's market value if you're 62 years older. The older you get, the higher that value percentage goes up. So depending on where your loan balance is and your value is, we can use the HECM loan, pay off your existing mortgage, and get rid of your mortgage payment so you'd never have to make one ever again, and then potentially get you a reverse the HECM line of credit. And there's one thing I just wanted to touch back on in going back to that client that John's currently dealing with. I just really want to encourage you folks. I mean, if you're a general contractor, by all means, and you have that capability, that's awesome. But if you are not a general contractor with actual experience under your belt, I don't mean just took the test, passed, and slapped the label on your business card. There are so many nuances to every one of these areas, and you will get stonewalled by this process, and you will end up spending way more money and way more time and potentially ending up with nothing or something poorly done or incorrectly done. And it's just best to start out on the right path from the very beginning by hiring the professionals. I just really want to encourage you guys to do that. All right, so that puts us right to 10:30.
Well, I've got one question for you, Jeremy, before we sign off.
Go ahead.
You know, I'm embarrassed to tell you that for the last several weeks and 10 episodes we've sat through, and I've listened to you talk about the HECM loan, I'm still trying to wrap my arm around that whole concept of actually making money with your HECM loan. I'm not connecting all the dots there. Could you explain that a little bit for me? Maybe
So
one final time.
Yep. So you're talking about the unused portion of the line of credit. So let's say you fund this loan. We'll use this previous example. Let's say somebody has a mortgage, a traditional mortgage for $100,000, and it's a house that's worth $500,000. Right now they're at 20% loan to value. We would use the HECM loan. We would fund it. That traditional mortgage would get paid off, so their mortgage payment is now zero. And then because they're, let's say, 62, they would just, for easy math, get access to about 42%. So 40% of 500 is 200,000. So in that case, they would have a balance starting out at 100,000 on the HECM loan, and then the HECM line of credit would have another $100,000 available to them to use on an as-needed basis. That HECM line of credit, granted, it's available to use of $100,000, but the balance on the line is nothing, zero. Right? So that $100,000 will grow at a growth rate. So if that growth rate is 5%, that means each year that available line of credit will grow by an additional 5%. Now, this is an example interest rate. Not everyone's going to have 5%, some higher, some lower. It just depends on where the market's at. So if at the end of the first year, you have not used any of that $100,000 in available line of credit on the HECM loan, your new line of credit would be $105,000 available to you. And the process just repeats. So, and it's compounding annually too. So next year you're earning, let's say, 5% on $105,000 in available line. And so it can grow fairly quickly. 10 years down the road, you've nearly doubled it. So because of the compounded interest. So, and again, you can use it on an as needed basis. You can use it for, Christmas presents. You can use, I've seen people strategize with this thing and they say, okay, I'm only going to take this thing out once a year. They wait till the end of the year. It's grown by their 4 or 5 or 6% or whatever it is at that time. They take just that amount that it's grown by out of their line. Now that amount that they use gets applied to their balance, but they still have that remaining line left to grow again. And so it's a really, really unique strategy to provide longevity to that line, because you can keep doing that and keep doing that and keep doing that. If you started doing that at 62 years old, you could feasibly do that until you're 150. And you never have to make a payment on any of that money. It gives you access to money to use on an as-needed basis when you want, how you want. It gives you the ability to actually enjoy your retired life.
It's almost like having a savings account with unbelievable interest.
Absolutely. And there's zero risk on it. The reason there's zero risk on it is because once it's funded, it can never be reduced and it can never be revoked. It's not tied to markets. It doesn't matter what the value of your home does. If we have a stock market crash and you have one of these lines, another thing that I like to teach people is using the line to draw from and leaving their investment portfolio alone. Because if you can leave your investment portfolio alone and allow it time to recover again, then you actually can make money. But if you have to, if for instance, I'll use an example of this. Let's say you have $1 million in your portfolio and you're earning 5%, right? You're getting $50,000 annually on your portfolio. Well, when the market crashed in, I don't know, February, March, and then 2006, 7, 8, 9, that whole time frame, 7, 08 was the really big crash. People lost 30 to 50% of their portfolios, in some cases 60 or 70% if they were really aggressively invested.
Yep.
And so now let's say you were one of those folks that only was lucky and you only lost half of it. So now you had $1 million at 5%. Now you have $500,000 and you're probably closer to 2%. Well, now instead of taking $50,000 out annually, which is $4,000 a month approximately, now you're only going to see about 2% on 500,000. You're only talking about $10,000 annually. So now what do you have? $800 a month. If you were relying on that money that you were taking from your portfolio in the terms of interest, now the only other option you have is to liquidate that portfolio to make up that difference of that $3,000 some a month. Well, now again, it's valued at half. It's the worst time possible to sell it. So if you had some other tool to draw from, the HECM line of credit, and you had the ability to leave that investment portfolio alone, an average recovery for any kind of market crash is like maybe 18 months. The longest ones in history haven't taken more than about 36 months. So if you had something you could draw from so that you could leave that stuff alone, what is the opportunity cost that you're giving yourself or taking away from your portfolio if you are forced to draw from that just in order to live your life? And keep in mind, this is a time where you're not going to just go jump back into the workforce. You're not just going to go hurry up and get a real high paying job again if you're in your late 60s or early 70s. It's just not very common. I mean, I'm not saying it's impossible, but it's just not realistic. And what if you were late 70s or early 80s when that happened? You're trying to leave a legacy to your family. The only way to do it at that point is to hopefully be able to have something to draw back on so that you can leave it alone.
Well, I'll tell you what, we can have a whole segment on this one, Jeremy.
We sure can.
We ought to do that sometime. But thank you. I mean, it does make more sense now. I appreciate that.
Good. Well, we're at the end, folks. We really appreciate you joining us. We look forward to seeing you guys on the next series we put together.